With us now, American Enterprise Institute economic policy analyst and CNBC contributor Jimmy Pethokoukis and Moody's chief economist Mark Zandi. Gentlemen, great to see you both. Jim, I'll start off with you. How do we get to compromise when neither side wants to compromise?
Well, I think in the end, both sides will want a compromise. I think what's important here is that, one, both sides are talking finally, and two, both sides believe not raising the debt ceiling would be very bad and probably are unwilling to try to play a game where it's not raised and there's a market fallout, but they can blame the other side. I don't think that's what either side believes. So that's all great news. The bad news is it is not obvious what the path is, the direct path is to getting an agreement. You can say, yes, there'll be some spending cuts or freeze over a number of years, but that path is not obvious at that point, which is why I think people should still worry.
Right. And we're working with the Janet Yellen, ex-date as soon as June 1st. That's actually sort of a span just because of the nature of the government's finances, Mark. At the same time, that ex-date is fine, but, we don't need a default in order to get a credit rating downgrade. And I don't know if that's something that the markets are factoring in.
Well, I don't think they're, Melissa, discounting a downgrade. No, that would be truly catastrophic, because if the Treasury's rating is downgraded, lots of downgrades will occur. Any institution that's backstopped in some way by the federal government will be downgraded. Systemically important banks, think J.P. Morgan Chase, Fannie Mae, Freddie Mac, Federal Home Loan Bank System, municipal government, that would be a real mess. So no, I don't think anyone's thinking along those lines, nor should they. I think that would be very, very unlikely, hard to see that happening. I should say, Melissa, although I don't speak for the rating agency, I'm not in the rating agency, so just so the listeners understand that.
Yes. And Mark, just to follow on there, how would you model, if at all, the economic impact right now? I mean, all we're really seeing is these ripples in the bond market where people are going to demand more out of yield on a 1-month Treasury bill because of a potential delayed payment. So that seems somewhat technical and mechanical. But at a time when banks might be tightening up on credit, does this become something material?
Mike, I think it becomes material very quickly. I mean, I think if June 1st, June 8th, the X date when the Treasury can't pay all the bills on time is early June, that's coming fast. So if in the next few days coming out of this meeting, we don't get a signal that, lawmakers, as Jim said, do want to come to terms and do want to increase the debt limit in a timely way, I think markets will start to react more significantly. In fact, I'll go far as to say, Mike, it may at the end of the day be necessary that markets react, because without some turmoil in markets, without some bad days in the equity market, without some increase in interest rates, some problems in the foreign exchange market, lawmakers may not be able to generate the political will that they need to actually sign on the dotted line and pass an increase. So we may actually have to see that turmoil before we actually get to a place where lawmakers can agree to increase the limit.
And Jim,
I hope not.
Yeah, I was going to say, it's really fascinating because almost everybody who comes at it from the finance side would probably look back at 2011 and say, we understand that markets panicked. We understand we had a potential debt downgrade that did come to pass of the U.S. government. On the other hand, in retrospect, it doesn't feel really smart to have panicked. If you bought the top before the 2011 crisis in the stock market, you broke even 7 months later. It was a really big buying opportunity. And yet, it's hard to say that if we actually go to the date, the political calculus is not going to be the markets will freak out and the other side will get the blame.
Yeah, I think that is a too clever by half way of looking at it if you're a politician. Listen, one can imagine a scenario where the Biden administration says, hey, we want to raise the debt ceiling. The Republicans are the ones adding these stipulations. So if there's a market shock, which pushes the economy perhaps into a recession, they're going to blame Republicans. I don't think that's necessarily obvious. If you're the president who has bad poll ratings and certainly does not need a recession heading into election, again, that is a real political high wire act, which I don't think the Biden administration wants to do. And I think neither side ultimately can be positive of how the political, chips will fall.